Today, let's talk about something a little dirty. On the evening of August 15, 2023, over 400 police officers in Singapore simultaneously raided 9 of the city's most luxurious residences. This massive operation was the result of years of covert investigations. One suspect, in a desperate attempt to avoid arrest, jumped from his second-floor balcony, spraining his wrists and ankles, and even hid in a sewer before being caught. In total, 10 suspects were arrested during the raid. Authorities seized luxury cars, priceless artworks, cryptocurrency, watches, designer bags, and cash, assets valued at over $1 billion. However, the investigation revealed 27 suspects in total. While 10 were arrested, the remaining 17 are still at large. The stolen money involved in this case exceeded $3 billion, mostly originating from an illegal online gambling platform based in Southeast Asia, along with some from illegal loan businesses and online fraud. These funds were then funneled through money laundering activities in Singapore, exposing what is now considered the largest money laundering case in the country's history. Today, we'll not only look at the details of this case, but also dive deeper into a topic that's even more ambitious and fascinating: money laundering itself. According to rough estimates by the United Nations, global money laundering amounts to between 2% to 5% of the world's GDP each year. That's likely more than $2 trillion. Right around us, everyday economic activities, whether in art, luxury goods, real estate, corporate investments, or even regular bank transfers, might be hiding money laundering operations. I've studied hundreds of money laundering techniques and classic cases. At first, it all seemed chaotic and confusing, but over time, I began to understand it better. So let's cut to the chase. What exactly is money laundering? First off, I want to emphasize, money laundering is absolutely illegal. Don't do it. This video is just to help you understand how it works, so you can better recognize and prevent it, and understand how the world operates behind the scenes. In simple terms, money laundering is the process criminals use to make illegally obtained money appear legal, so they can spend it openly without suspicion. You might ask, why bother laundering money at all? Why not just spend it? If you're defrauding a few $1,000s, say $3,000 to $5,000, you can probably spend it directly without raising too many questions. But what if you stole millions? Tens of millions? Or even hundreds of millions? Let me give you a simple example. Imagine a student, let's call him Batty. One day he finds a lost wallet at school, and inside is $10,000, a huge amount for a primary school kid. Batty wants to keep the money, but if he buys a flashy new iPhone and shows it to his mom, she's going to ask a lot of questions about where the money came from. So what's the ideal scenario for Batty? He wants to spend the money openly, right in front of his mom, and explain it in a very reasonable way. That's where money laundering comes in. Let's expand on that analogy. When the amount of stolen money gets huge, money laundering isn't just useful, it becomes absolutely necessary. Imagine you're a criminal with a massive amount of stolen cash. You have 2 major problems to solve. First, you need to make the money hard to trace. The people you defrauded will definitely report you to the police. So, you need to wipe your footprints clean and make it extremely difficult for the authorities to follow the money back to your account. Second, even if the police can't trace the money directly, you still have to explain how you're suddenly living like a millionaire. Imagine a regular office worker earning $2,000 or $3,000 a month suddenly buys a yacht. That's obviously suspicious and won't make sense to anyone. So, money laundering solves these 2 problems at the same time. It hides the traces, and it rationalizes or cleans the income so it looks legitimate. We'll soon see different money laundering techniques, but their ultimate goal is always these 2 things. Let's start with some classic and simple methods. Back in the early days, most criminals, like drug lords, dealt mostly in cash. So the most basic way to launder money was to use industries that naturally handle a lot of cash every day. Think about businesses like restaurants, laundromats, casinos, Go LD shops. These businesses have legitimate large cash transactions coming in and out daily. It's easy to mix in dirty money with the legitimate cash flow. For example, say your laundromat makes $10,000 a day. If you sneak in an extra $5,000 of illegal cash, your daily revenue becomes $15,000, which still seems reasonable. Regulatory agencies can't possibly count every customer or verify every receipt, so that extra $5,000 quietly gets cleaned without raising suspicion. So you see, this method perfectly solves those two problems. It removes traces and rationalizes the income. Here's a fun fact. The term money laundering actually comes from this exact method. Back in the 1920s, a famous mafia boss in the United States owned a laundromat to launder his illegal earnings. Hence the phrase laundering money. It's a clever pun that stuck around. In those days, mafia bosses and drug lords often ran legitimate businesses to cover their dirty money. But this method has its limitations. First, you need to actually have a physical business. If your restaurant barely has any customers, it's hard to justify claiming you earn $100,000 a day. The volume of business sets a natural limit on how much money you can clean. Also, it's impractical for a drug lord to suddenly become a hard-working laundromat owner. It'd be quite ironic, selling drugs one day and running a laundromat the next. As the scale of money laundering grew and regulations got stricter, this simple method became just one part of Allerger, more complex chain. To reduce risk, criminals often don't hold these businesses directly. They use shell companies or front people to manage them. Another classic cash-based laundering method is casino money laundering. Instead of opening your own casino, you simply go to a casino, which is perfect because casinos naturally handle lots of cash and chips. Here's how it works. You take your dirty cash to the casino and exchange it for chips. You play for a while, it doesn't matter if you win or lose much. Then you cash out your chips for clean money or checks. Now, if anyone asks, you can say, "Oh, I was just lucky at blackjack yesterday and won $3 million. This method makes the dirty money look like gambling winnings, a perfectly legal source of income. However, in the last 20 to 30 years, large casinos have become much more regulated. Just like banks, they've tightened rules on accepting large amounts of cash to prevent money laundering. So today, it's harder to launder large sums through casinos this way. It still happens, but usually for smaller amounts. Next, let's dive into some money laundering techniques that rely on converting stolen money between different forms of assets. This conversion makes it much harder for regulators to track the flow of dirty money. Art laundering. One popular method is using art. At high-end art auctions, privacy protections often keep buyers and sellers anonymous. Plus, many auctions accept cash, which is perfect for money laundering. The value of artwork can vary wildly, from $10,000 to $100 million or more. This price volatility is a playground for launderers. For example, in 2012, Mexico introduced an anti-money laundering law limiting cash in art sales. Overnight, a booming art market cooled off, and some rising artists lost market value. Could art really be a channel for money laundering? Absolutely, though of course not all art sales are suspicious. But dirty money can hide behind these transactions. Here's a classic trick. Say you buy a painting for $100,000. Then you get an expert to appraise it at $10 million. Next, you sell it to a shell company you own for $10 million. Suddenly, your $100,000 dirty cash looks like $10 million of clean income from art investment. Art is also used in bribery. Instead of handing over cash, criminals may give valuable paintings, eloquent, hard to trace, and easy to secretly cash in later. For example, a criminal might bribe Lao Wang by auctioning a painting attributed to Lao Wang's daughter, saying it's worth $10 million. The criminal's money is laundered and a bribe is paid, all in one go. Real estate laundering. Next up is real estate, the favorite of almost every money launderer. Real estate is less volatile than art, but easier to enjoy, invest in, and hide stolen money. In the Singapore case we talked about earlier, suspects owned 207 properties in Singapore alone. Two of them owned homes in Dubai worth $3 million. This is likely just a small piece of their global laundering network. Real estate serves many purposes in laundering. It can simply absorb large amounts of cash. In some countries, buying property with bundles of cash is accepted without deep investigation, like Dubai. It helps rationalize wealth. For example, if stolen money from a shell company is used to buy a house, then selling that house turns the money into legal income. When you deposit money from the sale, you say, "I got this from selling my house." Banks usually stop asking questions there. These launderers often care less about the property's actual value. They're willing to inflate prices wildly to justify the cash flow. This is one important factor pushing up housing prices in cities like Dubai, Singapore, Hong Kong, London, and New York. Gold laundering. Another common laundering asset is gold. Why gold? Easy to transport and carry, more liquid than art or real estate. Easy to buy and sell. Here's an amazing real-life example involving a Moroccan gang laundering British drug money through gold. A British drug lord stuffs cash in his car trunk. They meet at a public place, say Starbucks, to exchange coded messages. The drug lord secretly hands over the car key to a cleaner named A, who drives the cash to Paris. Contact B, an ambulance driver, takes the money and hands it to his brother C, who counts and bundles it carefully at home. Then two middle-aged women, D and E, transport the cash to Belgium. In Belgium, a black market gold merchant F converts the cash into gold, with forged receipts to cover it up. Gold is then flown to Dubai via Amsterdam, where it's converted back into clean cash. The cash is deposited in banks in batches and transferred to anonymous shell accounts worldwide. This gang laundered $250 million this way over several years. Why so many steps? Likely to avoid detection and regulations in different countries. The strategy uses physical cash transport, crossing national borders, and asset conversion to cover tracks and confuse investigators. How was this uncovered? An Ernst & Amp young auditor noticed Dubai's jewelry giant Kalati was buying over 3 tons of gold every year, way more than justified by normal business. He reported it. Police traced the network and arrested 25 people out of 27 gang members. The 2 bosses are still at large. Other asset conversions. Besides art, real estate, and gold, criminals also launder through luxury goods, diamonds, top-up cards, and even NFTs, which have become popular recently as digital art in the metaverse. Each asset conversion exponentially increases the difficulty of investigation. Criminals always seek anonymity, leave minimal traces, and avoid surveillance, sometimes even hiding from cameras when converting assets. Rationalizing income. Back to Batty, the student who found $10,000 and wanted to explain it to his mother. Rationalizing stolen money is a key part of laundering. Any anonymous investment can serve this purpose, buying a consulting firm, a trading company, or a restaurant. But money laundering businesses aren't about growth or profit. They want to maximize cash flow fast and quietly, not build a thriving business. Examples? Film and television companies are perfect. Projects have complex finances with many invoices, making them easy to fake. For example, a criminal might have Company A invest in a movie, then Company B blows up a set, costing $5 million, though actual damage is $1 million. The extra $4 million is laundered. Or they book an entire cinema's tickets for a fake blockbuster, laundering cash through box office revenue. Football clubs can also be laundering hubs. One Russian businessman, Tolstakov, bought Portuguese club Laria in 2014. The club, already struggling financially, became a Russian mafia laundering tool through player transfers, broadcast rights, and betting. In 2016, Portuguese police launched Russian Doll Operation, named after the nested Matryoshka dolls, raiding the club and arresting 3 mafia members. They noticed something suspicious. The club was near bankruptcy, but its owner lived lavishly, spent heavily on buying and selling players who never played. Trade-based money laundering. TBML. Finally, a common and powerful laundering method is trade-based money laundering, or TBML. Why is it so common? Large volume of trade means large fund flows. Customs rarely inspect every shipment. It easily enables cross-border movement of illicit money. How does it work? Over-invoicing. You import goods worth $10,000 but declare them as $10 million. Customs clears the shipment based on the invoice, so you can transfer $10 million legitimately. Under-invoicing. You import goods worth $10 million but declare only $10,000, then sell the goods for $10 million locally, turning illegal money into legal profits. The foreign trade partner must be a criminal collaborator. The examples I gave are extreme. Real-world cases use smaller margins, like invoicing $500,000 for $1 million. Next, we talk about cross-border money laundering and AMP, shell companies. Many countries don't have strong cross-border capital controls, which means criminals can exploit the gaps between different countries' regulations to launder money. One of the sneakiest tricks is called mirror trading. From 2011 to 2015, a Russian broker named Volkov used this technique with Deutsche Bank. Here's how it worked. Volkov's Russian company would buy about $10 million worth of Russian blue-chip stocks using rubles. At the same time, he asked a trader at Deutsche Bank to sell the exact same stocks for roughly the same price, but in an overseas account registered in the Virgin Islands, converting the proceeds into US dollars or euros. The domestic purchase and overseas sale balanced each other out. But Volkov effectively moved rubles into foreign currency, completing a cross-border currency exchange while avoiding regulatory oversight. Deutsche Bank made a profit from the spread, and this went on for 4 years. By 2015, over $10 billion had moved through this scheme. Volkov's brokerage became an underground Russian money transfer agency for oligarchs and wealthy Russians. The fallout? Deutsche Bank was fined heavily, £163 million by the British Financial Supervisory Authority and $425 million by the U.S. Department of Financial Services. Mirror trading isn't limited to stocks. According to Xinhua Net, criminals have also used game currencies and point cards to dodge China's RMB exchange controls, laundering nearly 40 billion yuan this way. Shell companies, the core of money laundering. We've talked about many ways criminals rationalize income and isolate assets. But there's a most common and core tool in modern laundering: shell companies. What's a shell company? Simply put, it's a company with no real business activities, often registered in tax havens like the Virgin Islands, Bermuda, Cayman Islands, or Panama. Registering one is quick and easy. Sometimes it takes just a few minutes online, and often no real personal info is required. Agents help set them up and act as local representatives, so the true owners stay anonymous. Opening bank accounts for these companies can be trickier, but is usually done via trusts or intermediaries. Shell companies and their bank accounts become the nodes of a criminal's global asset network, the foundation of their laundering chain. Here's a classic example from the 1990s involving a Mexican gang. They deposited stolen cash in Luxembourg under Shell Company A as a fixed deposit. Then used this deposit as collateral to get a loan from a Gibraltar Company B in Paris, adding another layer. Finally, Company D transferred money to a Panamanian Shell Company C. Try to follow this labyrinth if you're a regulator. You must trace Panama's shell companies, but Panama has strict bank secrecy laws. Then navigate Paris customs and Luxembourg's banking system. Recovering stolen money after passing through such a maze is extremely difficult, and even if recovered, often very little remains. Why do shell companies exist? Why not ban them? Good question. Shell companies have legitimate uses too, like managing complex corporate structures where different people control shares via separate companies. Cross-border tax planning. The problem isn't the companies themselves, it's weak regulation in certain jurisdictions that lets criminals abuse them. Some tax havens protect privacy so fiercely that they hinder anti-money laundering investigations, attracting illicit funds. Since 2017, the US and EU have pushed these places to improve their regulations, but changes happen slowly and reluctantly. Cross-border regulatory differences. A criminal's playground. This whole shell company setup exploits gaps and differences in global regulatory regimes. If all shell companies were in one country with strong oversight, it would be easy to track them. But once you add national borders and bank secrecy, the game changes dramatically. Layering and identity. Theft criminals also use layering, moving stolen money through multiple bank accounts to hide its origins. In China, for example, criminals might open many bank accounts in stolen identities. People whose info is stolen may not even know their names are used to open these accounts. Imagine this. An elderly man in Beijing is scammed out of wires to $300,000. The money moves through dozens of fake accounts, often not under the fraudster's name, then is wired overseas to a bank account in Panama. By the time he calls the police, it's practically impossible to recover the money. The 3 steps of money laundering: placement, layering, integration. You may have heard these terms. Placement: getting illegal money into the financial system. Layering: moving money around through multiple transactions to obscure its origin. Integration: bringing the money back as apparently legal funds. These terms are useful but often too abstract. Real cases rarely fit neatly into these boxes. I prefer to focus on the 2 underlying principles: eliminate traces, rationalize income. For example, shell company transfers form complex layers to erase traces, classic layering. Involving innocent people. Top-up scams. Some criminals trick innocent people into laundering money without their knowledge. How? They offer top-ups for game credits or mobile phone balances. They say, top up 80, get 100. You pay 80 thinking it's going to the game operator. But the money actually goes to a laundering intermediary. Later, they send you 100 back, creating a closed money loop. You just became a layer in a laundering network, unwittingly. Underground banks, complex networks. More advanced layering involves different people sending and receiving funds in a network, where none seem connected. This is called an underground bank, a hidden system where accounts appear unrelated but are linked behind the scenes. Fighting money laundering. Technology and challenges, regulators are fighting back. For example, Singapore uses AI to monitor payments across networks, flagging suspicious activity like one device logging into thousands of accounts. Multiple accounts using the same Wi-Fi. Accounts making repeated reverse transactions. The Singapore $3 billion case. One of the biggest laundering cases in Singapore showed how criminals bypass bank checks by forging documents, fake property certificates, employment letters, and wealth proofs. They then moved money worldwide, buying hundreds of properties, luxury cars, yachts, and crypto. The case led to 27 arrests and billions in confiscated assets, auctioned off to government funds. Crackdowns shift. Capital flows. Singapore has since tightened laws, especially on wealthy overseas investors. This has pushed some rich people to move assets or set up family offices in Hong Kong instead, which now sees a big influx of capital. This is not a claim that all money flowing to Hong Kong is dirty, just that wealthy people prefer smoother, less restrictive financial environments. The core challenge: know your customer, KYC. Banks rely heavily on frontline account managers to implement KYC, knowing who their customers really are. But there's a conflict of interest. Managers want to attract clients and deposits, while compliance wants to scrutinize customers carefully. Sometimes, to keep customers happy, managers might skip or relax anti-money laundering checks, even collude with clients. Why money laundering is so rampant? Money laundering is a global game between criminals and regulators, between countries with different laws, even inside banks, between departments. To end, let me be clear, money laundering is a crime. Don't do it. It ruins societies, fuels corruption, and hurts innocent people. Thanks for watching. If you want to know more about how authorities fight back or how digital currencies are involved, drop a comment.